Ever wondered what goes on inside an investor's mind when they deciding whether to fund your business? It's not about gut feelings or flashy ideas. It's a calculated process based on data, structure, and potential. If you want to secure that funding, you need to think like an investor. Let's break down exactly what they're looking for, step by step. First up, market opportunity. Before they even look at your product, investors are looking at the market itself. Is there a genuine, pressing need for what you're offering? How big is your potential customer base? Are we talking about $1 million pond or $1 billion ocean? And critically, is this market growing or is it shrinking? Investors love big, expanding markets because that's where the real growth potential lies. They want to see that you're not just fishing in a small pond, but you have the potential to scale up and become a major player. Next, they dive into your business model. This is all about how you actually make money. What are your different revenue streams? Is it a one-time sale, a subscription, or something else? How did you decide on your pricing? What's your strategy for acquiring new customers, and how much does it cost? And of course, what are your profit margins? Investors are drawn to business models that are clear, simple, and scalable. A complicated, hard-to-explain model can be a major red flag, so keep it straightforward and demonstrate how it can grow. Then comes the part everyone dreads but is absolutely crucial: financial performance and projections. Numbers don't lie, and investors will scrutinize yours. They'll look at your startup costs, your revenue projections for the next 3 to 5 years, your day-to-day operating expenses, and your cash flow. A key metric they focus on is your break-even point. When do you stop losing money and start turning a profit? The key here is realism. Wildly optimistic, pie-in-the-sky forecasts will kill your credibility. They want to see well-researched, data-backed financials that show you have a solid grasp on your numbers. So you've got a great market and a solid financial plan. Now, investors will ask why this is your competitive advantage. What makes your business special? What's your unique value proposition that no one else can offer? Do you have any barriers to entry, like patents or proprietary technology, that will stop copycats? How are you different from everyone else in the space? A strong, defensible competitive advantage is like a moat around your castle. It shows investors that your business isn't just a fleeting success, but something built to last. But even the best idea in the world is worthless without the right people to execute it. That's why the team is so important. Investors often bet on the jockey, not just the horse. They'll look at the founder's past experience, their deep knowledge of the industry, and their leadership skills. Can this team actually deliver on the plan they've presented? Many seasoned investors will tell you that a top-tier team can turn a mediocre idea into a success, but a weak team will run a brilliant idea into the ground. Your team's credibility is a massive asset. Every venture has its challenges, which brings us to risk assessment. Investors aren't naive. They know things can go wrong. They will assess all potential risks. Market risks like a sudden change in consumer trends, financial risks like running out of cash, operational risks in your supply chain, and any legal or regulatory hurdles. But they're not just looking for a list of problems. What they really want to see is that you have identified these risks yourself and have a clear, proactive plan to manage and mitigate them. This shows foresight and responsibility. Finally, investors need to know how they'll get their money back with a significant return. This is the exit potential. They are not donating to a charity, they are making an investment. So, they'll consider the possible exit strategies. Is your company likely to be acquired by a larger player in the industry? Is there potential for an IPO down the line? Or will the business generate enough long-term profit to provide dividends? A clear and plausible exit strategy, even if it's years away, makes your business a much more attractive investment proposition. So, to recap, investors are looking at your market, your business model, your financials, your competitive edge, your team, the risks, and their potential return. When you prepare your pitch, make sure you have a compelling story for each of these 7 areas. If your business is well-planned and professionally presented, you'll build the confidence you need to get that yes. If you need help preparing an investor-ready business plan, financial model, or feasibility study that ticks all these boxes, we're here to help. We are WBS business planning experts, and our job is to help great businesses like yours get evaluated positively by investors. Thanks for watching, and don't forget to like and subscribe for more tips on growing your business.